Okay, welcome everyone to Macro Ace with your host Tony, going through the EIA inventories for today. Quite a bit to cover, so I'll be skimming through some of the bits as best as I can. But what is the EIA inventories release? So it represents the weekly change in crude, gas, and distillate inventories, and it mainly affects areas of the economy such as transportation, also consumer prices for a number of products too. Don't forget, a lot of products that are created are made with oil, and you've always got to factor in that gasoline prices for what you're paying at the pump is also can also be affected as well, depending on how much of a build or draw that we get consecutively week by week. So it can be very uh, can have a big impact on the economy in the US in every area. So why is it a release to watch? So we know that it's a very volatile trade where some points, some releases we can get up to $2 moves. Recently we've been seeing about the highest we've seen recently is about $1.30 for one release, but it can cause some quite big moves when sentiment isn't impacting it too much, or isn't weighing the overall market's feelings and what traders are focused on. Then, how does it affect the markets? So this is the key, the very basic of what we need to understand when we're looking at the oil inventories data is that when more oil is added, FXpert says, can you wait 1 minute or like 30 seconds before starting? Because when I get the live stream notification and I press on it, you're already talking and I miss what you are talking about at the beginning. Okay, cool. Sure. I will do that for next time. Apologies if I missed out on anything for you, but I'll keep that in mind. And yes, I'll do that for next week's releases. So looking at how does it affect the markets? The key thing to remember is then that when there is more oil added, or when there is a build in inventories, it's negative oil, and when there is less oil added, or where there is a draw, it is positive oil. So we've got to consider and remember that when there is more oil being supplied in the market, but there is less demand for it, then what that can lead to is a decrease and appreciation in crude oil prices. And we've seen in the markets, not only with the economic releases for EI inventories and API data, but also with headlines as well that we've seen that have come through to us on the financial news feed as well. So just to bear that in mind, basics, there's a build, it's usually negative for oil, and if there's a draw or less oil added, it's more positive for oil. Then the triggers. So according to economists, they're looking for a high of 4 million with a low of minus 2.5 million. Gasoline looking for a high of 2 million with a low of minus 2 million. Distillate with a high estimate of 1.4 million and a low of minus 1 million. So if we're looking at today's median forecast, then from economists, they see 2 million, or they see a draw on the inventories data. And then the gasoline seeing a build at minus 1.4 million compared to the prior of minus 3.6. And distillate just expecting a build there as well to minus 0.6 million compared to the prior of minus 0.9 million. So overall data, so the expecting a draw on the headline figure, and economists are expecting a build on the other two bits of data as well. Okay, so just the median projections then. Now, API data, what I mentioned earlier, it's used as a way to gauge as to what the following day or the official data from the government or the EIA will be. When I say what it will be, I mean which direction the inventories data is going to be headed in, whether that is a build or a draw. FXpert says, what does triggers mean? So when I say triggers, we're looking at, or what economists are looking at, and for ourselves as well, what we're looking for, or what the figure that we're looking for, okay? Or the minimum and highest, or the minimum and maximum figure of what we're looking for to see a market, a strong market reaction, right? So that's what economists. So that's what I mean by triggers. So, so on the Financials website, you can also use triggers here. So if a figure meets your, if you're looking to buy or sell crude oil, and you've put your trigger in for 4 million, and it comes in at 4 million or above, it'll pop up with a little buy or sell signal. So that's what trigger is basically. What is the figure that you're looking for in order for you to take a form of action? So when we talk about triggers, we look at what economists are seeing, and also what we've seen in the past, and then kind of match that up together to get an overall idea of what sort of figure, particular figure to look at. Okay, so API data, as said, so for some traders, what they do is that the night before we get the private data that a lot of traders do have a look at and try to trade. So the data that the reason why traders look at it is that there has been in the past a correlation with API data and EIA inventories data. If API data overall was a build, or if the headline figure crude oil inventories showed a build or a draw, sometimes you can get the EIA data for the following day showing a build or a draw, or in line with the same direction as the API data has shown the night before. But there isn't a very strong correlation, as a lot of the time, sometimes you might not get a correlation in movement at all, where you might get API data that's, let's say there's a build, and then the actual EIA inventories data shows a draw the following day. So I think it's more so just for traders to keep an eye out for, and they do try to trade it, and then try to guess, they try to position themselves for the EIA data the following day. But if we're looking at the crude oil stock change data that we'd seen last night, it did show a draw of minus 2.445 million compared to the forecast for a draw of 1.533 million, or showing or the forecast of 1.533 million compared to the prior of 1.618 million. One survey inspection says, "Love your show. I hope you keep going." Thank you very much. Hope you find it useful as well. So then, with the other bits of data, so API distillate stock change, with figure come out as a build at 1.075 million compared to the prior of 0.662 million, and then gasoline stock change showed a draw of minus 5.1 million compared to the prior of 0.82 million. So more or less, overall there was a draw in inventories data, or the API data that we'd seen, and the market reaction was this. So what we had seen recently in the past with the API data, there wasn't a market reaction or something for us to look at, and or for me to show you recently during at the beginning of the Russia-Ukraine conflict up until yesterday. So yesterday, this is the market reaction. So the data was released around 4:30, and it's as I said, it's private data. It's not readily available to the public. So what happened was, overall though, when the data did come out, we had seen a push towards the upside here on crude oil, on WTI crude oil, off of the back of the bigger draw overall with the API data. So that was the reaction there from the markets, from WTI crude oil. At the moment, what do we see? if we're looking at crude. So we're still above $100 a barrel at 112 now. But now we're seeing a bit more volatility creeping back in with these economic releases, especially what we'd seen last night with the API data actually having a reaction to the data that was put out. So could that mean even though regardless of whether it's a draw or build, would that mean for the oil market today with the EI inventories data, will we get more of a stronger reaction compared to what we've seen previously? That's yet to be seen. But at the moment, we're currently down about 0.8 on the day so far. Still, as said, above $100 and around $112 a barrel WTI. Then, if we go to the next point, so what's driving sentiment at the moment? So you have, since the beginning of the year, oil has appreciated more than 50%. Okay, so again, a lot of that being helped by the Russia-Ukraine conflict, seeing an escalation or a huge appreciation in crude oil prices because of the geopolitical uncertainties that surround Russia and Ukraine, and of course Russia being one of the OPEC plus members as well. So that did have an impact on the price of crude overall so far this year. So oil tariffs. This has been quite fun, actually. So yesterday we had the US, and according to our sources, the US would propose tariffs on Russian oil as an alternative to embargoes. A method aimed to maintain the country's supply on the market, but reducing earnings to Moscow. So WTI, around or after that headline had come out, according to a source, that we had seen WTI trading at around $114 a barrel off of that uncertainty that, okay, there's going to be less oil supply to the market, right? And in turn, for other nations, they would have to pay, they might have to pay more money to pay more money if they're still looking to get Russian energy via maybe other markets rather than the normal market, i.e. maybe the black market, or try and work their way around the sanctions and restrictions, or they'll try to pay more. They will have to pay more money to look at other countries to find a sort of loss of supply from Russian energy instead. So that's what happened yesterday. That's what had caused some extra volatility in crude oil, and we had seen that appreciation. And then later on in the day, tariffs on Russian oil might be linked with a phased oil embargo, according to Yellen. So again, just adding that they could go, so more or less confirming that they would look to do an oil embargo and also impose tariffs or tax on Russian energy. So really trying to impact the supply of Russian energy to the rest of the world. But if we look at other areas too, so we had the retail sales data yesterday that has shown that retail gasoline prices in the US have passed $4.50 a gallon for the first time just a couple of weeks before the start of the summer driving season. And that came amidst, again, significant tightening in the global oil product markets. So if it's becoming more expensive, again, there's just more of, if we're looking at the bigger picture for the US economy itself, how the conflict is having an impact on supply of energy, and also what the EU is looking to do to try and restrict Russian energy flowing to Europe. That's having an impact to some degree in the US as well. And then China COVID easing. So again, this is more of there's pickup in demand as well. Why we had seen WTI see an appreciation yesterday. So you had Shanghai that reported no new COVID cases in the broader community, allowing for reopening. Again, the more demand that there is, the higher higher oil prices go. One section of Beijing's Fengtai neighborhood will be closed for 7 days, highlighting the country's ongoing battle with the virus. So China's been very strict with their lockdown measures, even though initially had sporadic cases which were being reported in Shanghai. Then when the Chinese had decided to go into full lockdown mode, or lock down certain parts of the city, I should say, block by block, that had a negative impact on not only the crude oil market, the oil market, but also on the indexes too. So that negative sentiment of less oil demand from China because of their lockdowns in key areas of the country, Shanghai being a hub for industrial production and manufacturing of goods. Having that closed down had an effect, or a negative effect, on oil. But seeing the reverse of that, and off of the back of China opening up Shanghai again. Now, another interesting point to bear in mind. So on the weekend, we had comments from Saudi Aramco with their earnings. So there's a shift in what to focus on when we're looking at oil, when in the news, and also for the global economy as well. So the initial bit of news or focus was on how there being less oil being provided to the global economy if Russia decides, if there are sanctions imposed on Russia. But now actually it's talking, we're looking, according to the Saudis, at the refining capacity and the pipelines that they have open to provide the oil that is needed. So Aramco earnings, they said the refining shortage is causing the price differential between crude and refined fuel to widen. And in the US, gasoline and diesel pump prices have lately reached all-time highs. So off of the back of that, the Saudis, or Saudi Aramco, because of the increase in demand for oil, off of the back of countries not wanting to be stigmatized for looking or still wanting Russian energy, the profits from Q4 to Q1 for Saudi Aramco jumped by about $10 billion. Right, so really, in the past they were, seeing about 5 billion from each quarter. So it's a steady jump, steady move, and then boom, jumps up by $10 billion. So again, just an indication of how tight the oil market is at the moment, and how it's having an effect on the wider global economy too. And pumping more oil won't ease gasoline prices. There is no refining capacity to match the present demand and expected demand in summer. That was according to Saudi Energy Minister Abdulaziz, who made a comment at an energy conference in Bahrain, adding that the bottleneck is refining, and many refineries around the world, particularly in Europe and the US, have shattered in recent years. So due to the shock demand that is coming back, or is being amplified with these restrictions and embargoes, potential embargoes being placed on Russia, and the stigma around looking to Russian energy is leading to nations looking at their own pipelines to start pumping more oil, which there hasn't been done so much of, and then try to bring them back online to try and meet demand. Okay, so we'll go about 11 minutes. Europe. So we have Europe. Energy giants pressing ahead with plans to keep buying Russian gas, and that was obvious when we had news yesterday with Italy's ENI, which opened up ruble accounts on caution, or in a cautious way, with Gazprom Bank. So what the EU had mentioned is that they wouldn't stop ruble payments altogether. They're not clear as to what sort of action they're going to take. It's been very choppy and very messy with how Europe's trying to deal with the Russian energy with Russian energy, and how that's going to affect, one, politically, or how it will look, and two, for economies as well in Europe that rely on Russian energy, such as Hungary, right? So Hungary have mentioned in the past that, and they're quite a bit of a sticking point for the European Union at the moment, is that if they were to withdraw or cut themselves off from Russian energy, well, that they will need about 770 million euros in order to find other sources or sources of energy that they need for their nation. So one thing the EU has said that they will try and do to help alleviate or cushion the blow of losing access to Russian oil is that they've said they'll provide $2.1 billion, or about 2 billion euros, to nations. It's not clear how they're going to make that up, or how they're going to distribute that money between nations in the European Union. But I see it more going towards Hungary, if they're being the sticking point at the moment in negotiations with the EU. But this is important to understand, is that there is the situation in Europe, as said, is messy, and it's not clear as to what Europe wants to do with Russian energy, whether or not they're going to stop ruble payments altogether for gas prices, or whether or not they're going to allow or continue to allow ruble. They're going to allow ruble payments for Russian energy. So that's adding some volatility in the markets at the moment, and we've seen that recently as well. And it's quite obvious with headlines that we've seen in the past, with von der Leyen wanting to cut Russian energy off by Russian crude by 6 months, and that led to an appreciation in WTI crude oil. And the May 11th, you had from India, oil consumption rose 12% year on year, the most since April 2021, to 18.6 million tons. Again, more of a demand stepping in. And then fuel pressure, gasoline prices have surged high in recent days. So you have your WTI futures and gasoline futures. Again, you can see that in line together, seeing that appreciation in gasoline and gasoline prices, or fuel prices altogether. Again, the more demand that there is, the more expensive it's going to become to provide that energy. So just a nice little piece from Bloomberg on one of the articles that I just took a little snippet of. Investment bank views. So Saxo Bank say the potential of a rise in Chinese demand, if they manage to contain the virus, will provide another layer of price support, according to Hansen. And Tuesday's movements were minimal, with a bear and bull pulls being basically similar for now. So sentiment being a little mixed as to what the market direction might be for the future. And then today, from Hansen as well, just talking about the focus has shifted, as I said earlier, the focus has shifted from range-bound crude oil market to the product market, where gasoline, diesel, and jet fuel prices have risen to levels not seen in years, if ever. So part of the, as said, part of the issue is that refinery maintenance and getting those pipelines back up and running, try and meet the demand, is causing an extremely tight market for crude, and not only crude but also gasoline prices, the gas market too. So just to be aware of that, there's extra volatility that has appeared in the markets. So we've got about 4 minutes left. We've got about 6 minutes left, and we'll go through the deviations. So if you've seen on the mailing list, which I provided for you, the deviations, you would see that last week's EIA inventories data was a huge build overall in data, where we'd seen about 10 million. That is 10 million deviation in the figure. And now, usually for what we've seen for our economic triggers, when there's been higher uncertainty or increased volatility in the energy market, is we usually look for a deviation of about five million. So with crude oil inventories data, we'd for ourselves, uh, we'd be looking for about 8 million, around 8 million as a build in figures, and then about minus 3 million as a draw if we do get that figure. If about minus 3 million as a figure itself. So about 5 million deviation either way is what we usually expect, is when there's a bit of a pickup in volatility. But even then, and also what we look for is the other bits of data too to move in the same direction. I.e., if the headline figure is a build, then we'd look for the other two bits of data to also show build in order for us to see a stronger reaction. But sometimes what can happen, and what we've seen in the past as well, is that when overall data has been more or less in line with expectation, or there isn't that much of a deviation, then we do get more or less smaller moves in the markets that we have seen in the past. So again, here we'd seen that although there was an overall build, draw in the figures that we received on the 4th of May a couple of weeks ago, it still wasn't. It didn't really outweigh the headline figure by that much, really, which had seen about 1.9 deviation. And we'd seen about even then we'd seen about 57 ticks towards the downside, and then about 10 minutes later, we're about 2 ticks. Still, we're down by 2 ticks, and the peak was about 1 minute. 1 minute, and we've seen about 65 ticks towards the downside at that peak. Last week, we'd seen about 46 ticks down, and then 28 up, and about 10 minutes later, we're about 105 ticks up. So, if we play the video, we've got about 3 minutes left. Go. Okay. Oops. What, 2 minutes? Okay. So data, what we've seen overall, if I can, okay, so about 2 seconds. Okay, so data comes out as a build, and then on the headline figure, there's a 10 million deviation. Did see some movement towards the downside there. I said about 46 ticks down, and then about 28 ticks towards the upside. And then if we kind of skip ahead a little, we kind of move ahead a little bit more, what we had seen. So it's still holding down for a little bit, and then on the same candle, it reversed that move towards the downside, started to move back towards the upside, and wiped out the release. Basically, I went back to pre-trading levels. So that was the reaction there. We got about a minute left. Let's get to the charts. Okay, 35 seconds. And let's get tick strike up and running. So as seen before, if we see that data if we see that there is an overall build, if we see that there's an overall build in inventories data, we'd expect some move towards the downside on WTI. Okay, go. So a draw. So showing minus 3.394 million. A draw on the forecast of. Whoa, that's kind of glitching out. Whoops. Draw on the forecast of 2 million. Gasoline inventories also showing a draw as well, showing minus 4.479 million compared to the forecast of minus 1.4 million. And EI distilled inventories a build of 1.235 million compared to the forecast of minus 0.6 million. So did see some movements towards the upside there on WTI crude oil. We're looking at our deviations. Bring it up. All right. So this was 2 million. We just got data out at minus 3 spot. There's about a 5 million deviation, 5.3 million deviation on the headline figure. Gasoline was also a draw as well. Which we've seen about a 3.3 million deviation. And then distillate. And there's a deviation of about 1.8 million for distillate. Okay, so did see that initial pop towards the upside on WTI crude oil. Just measure. Actually, there was a little bit of a jump. So first, I'm just going to measure the candle itself first, going to the top of the wick. So there's about 40 ticks towards the upside, and then if I go from the jump, it's about 55 ticks towards the upside. So a bit more. Didn't really stand out that much with the figures, even though there was an overall draw, was quite a strong draw of about 8 million deviation with the headline figure gasoline inventories, or about 8 million there. But seen about 43 ticks towards the upside on the candle that was created. And that's reversed itself. Okay. So, I just want to just check to see. Okay, yeah, so there's a quick flash move towards the downside. My apologies with if you're trying to look at the previous market reaction that I had. That was my fault. I'd forgotten to put it on to the exact time that the release had started. So there's a little bit of faff that happened there. So apologies for that. Still, okay. So it did kind of, yeah. So it did go below its pre-trading levels or pre-release levels for a little bit, but still holding up above that. Well, still holding up above that there. Although, of course, yeah, new candle is lower than its pre-trading level. But just looking at the bottom of this here, still okay. Forgot I said that. Might look like see what happens, but not really a strong reaction to the release. A very whipsaw reaction, what we'd seen. from the release. Okay, I had a question here. Tony D says, "Man, why not put the DOM on screen to see real dynamics?" When you say DOM, what do you mean? Just to bear in mind, there is usually a slight delay on YouTube and it's streaming. Okay, right, that's push. All right, that's yeah. All right, markets are kind of taking their normal moves now on crude. So it's seen a flash move towards the upside, and that's it. It's moved back. So yeah. So one thing to bear in mind then with the economic releases and where you can get the, of course, you're looking at it in real time on the flash. Well, that's a lot of glitching. Maybe we'll just keep it like that. One thing you can do is with the Squawk service or live voice and text feed. Okay, that's quite key and very important for traders to use. One of the reasons why it's important is that investment banks use it. So this is an investment. So the Financial Juice Pro product that we have is at an investment bank level of speed and providing you voice and text service of news in real time, 24/5, right? News is used as a way to understand what's moving the markets, right? What's actually causing the moves in the markets, and how to from that to try and be able to manage your risk. Okay, or you could take it as a way to take it as a trading opportunity. But a lot of the time, from what I've seen and speaking to other traders too, is that Squawk service is used as a way to manage their trades, and also to understand what's happening and why things are happening in the markets the way that they are. So if you have sentiment-driven news that is dominating the markets more so, then but you're not sure of what news has come out or what's caused the movement in crude oil or the S&P 500, then keeping an eye on the news feed is very key to be able to try and understand that there. Okay, so it looks to be actually so that makes up 9. Looks to be reversing its moves, reversing its gains from yesterday anyway. So now we're down about 1.7 on the day so far. And yeah. Okay. All right. So yeah, so that's why a news feed is quite important to listen out for. So with Financial Juice, what you get is so this is the thing. So you can listen to Financial Juice Lite or the free version of Financial Juice, but in the pro version, what happens is that first of all, you don't get any adverts being played. Second, you can see the news in real time, so there's no delay to the website. Usually there's a delay of around 10 seconds, so you don't get any delays with that. And also you can set your economic releases for, let's say, a figure. If actually I'm going to probably stop that. You can set your triggers for economic releases as well. Once over inspection says, can you use the service sometime during your stream? I am currently using it at the moment here. I mean, we can put on the voice, but bear in mind, YouTube, there's a slight delay, or there is a delay to it. So it's better to actually sign up and to be able to use the service rather than listening to me talk at the same time over it, which make it a bit more confusing. But yeah, so you can set up your own economic release triggers here on the side that you can manually put in. So if you were looking to buy crude oil, if we had seen about 3 million, if we had seen a 5 million deviation on the headline figure, then what it will do is it will let you, once you've set that up manually yourself, when the figure comes out, if it meets your requirement or your trigger, okay, then it will show either a buy or sell sign for you on the side, depending on what you've selected as your parameters. So don't forget, you can change these bits here to whatever you want it to be. But yes, so that's the economic release triggers there. So we've got a 7-day free trial of that there. Also a reminder as well, you can also with the pro version, you can also use our news desk to ask questions to our analysts, to ask what's going on, if there's something you don't understand, or what you're looking for, what you're expecting for the day ahead in regards to news or maybe the markets. But not, of course not saying which direction the markets are going to go, but of course just giving you more detail as to what's moving the markets at the moment, stuff like that, etc. So that's Financial Use Pro with a 7-day free trial that you can get there. Also, a reminder, if you're also watching this too, you can see tick strike going off here for crude oil, for light crude oil. Now, what tick strike does is it provides a visual and audible version of order flow, right? Or how much momentum that there is within the markets for a certain assets. If you're doing what I'm doing here, looking at various different assets together. So if you imagine yourself on the trading floors back in, let's say, the 80s, and you were standing there with the guys and girls and the markets are about to open up, and it opens and everyone says buy, sell, buy this, and they've got all the hand signs and gestures going off around them, and they're flashing people with their little cards and stuff and putting in their orders and ripping them up once the trader's done and throwing it on the floor. So just imagine that tick strike is that, right? It lets you, as said, listen to order flow and visualize order flow too. Again, it's all about how much momentum is there or volatility is there within a certain asset. So with crude oil at the moment, so we can, if you've been watching this at the same time whilst I've been talking, and the ticker here, actually let me move it out of the way. You can see that as we had seen a bit more buying momentum coming through, we'd seen some movements on crude oil. We'd seen tick strike showing some movements as well, also showing some buying coming through. What you can do is you can change the level of sensitivity. So if you don't want tick strike to always show you like now, for a move like that, we've seen a bit of a move towards tick strike had popped up. If you don't want to see the small moves that are happening in the markets, and you're looking for maybe stronger momentum, you can adjust the level of sensitivity to be able to do that. So you can do that all the way to 15, which is the least sensitive to the markets. And only when there are big, huge swings or big amounts or a lot of momentum or volatility that is impacting that asset will it then appear with a visual or an audio notification, let's say, in that way, in real time. So, of course, I've got mine set at 1. I like to see how, in real time, of course, I like to see the movements that are going on in the markets, little chops and changes. Particularly if you're like a day trader too, then keeping an eye on, maybe your thing is swing trading, which a lot of people, excuse me, not swing trading, scalping. With scalping, a lot of traders use tick strike to be able to kind of capture and jump on the markets and how they're moving. So it depends. Whatever your style is, whether you like scalping or whether or not. But less so. Yeah, so if you like scalping, then it could be quite a perfect thing for you to do. But as you can see here, so there's more selling momentum coming through. and Tick Strike is showing that there. All right, so we have a 7-day trial of Tick Strike, which is available for you to use, to have a go with, and have a little tryout for. Also, if you like the video, do give us a like, share the video, subscribe to our channel, and also don't forget to give us a follow on Twitter as well. We're here, we exist, so have a little look there and give us a follow on Twitter as well. Other than that, that basically concludes the release. So not really. I said flash moved towards the upside, and then next candle, well, it wiped out that. It went back to its pre-trading levels. All right. Thank you very much for joining me. I will see you next time. Also, don't forget to sign up to our mailing list too, because on Sunday I'll be putting out the mailing list, which will not only show you the news to expect, the sort of news to expect or what to expect from the releases as well, but also the deviations that I'd shown you on here that you can see. The deviations that I've been showing you here, you can see as well, so you can kind of prepare yourself as to what to expect for the week ahead, or for particular releases that we have coming up. All right, thank you very much again, and I will see you next time.